My name is Francis Bouchard, and I thank you for inviting me to share observations on the challenges and opportunities that escalating climate risks are posing to the broader insurance sector. I also want to congratulate Commissioner Kreidler for a wonderful career and good luck in whatever's next. As my bio indicates, I serve as Managing Director for Climate for Marsh McLennan, the world's largest professional services firm in the areas of risk, strategy, and people. In addition, I'm the inaugural climate leader in residence at Duke University's Nicholas Institute for Energy, Environment, and Sustainability. I also serve in various other leadership roles in organizations that are actively addressing climate issues, including the disaster resilience and recovery nonprofit SBP, the climate insurtech incubator Insure, and the women's extreme heat protection NGO called Climate Resilience for All. The main messages I want to get across this morning are the following. First, that the system level and forward-looking nature of climate risks are challenging the insurance sector's traditional risk signaling and policyholder incentive roles. Second, that the climate adaptation landscape is inherently local, yet it involves every level of government. In other words, it's highly complex. Third, that early signs are emerging of new innovative thinking and system-level focus across insurers and supervisors, and that by working together in 5 critical areas, we, meaning insurers and supervisors, can create the enabling environment for the meaningful action that's needed to address climate change. These observations stem primarily from 2 core beliefs I've forged through hundreds of discussions I've had with insurance peers and external partners active in the climate issue. First is that the industry's capabilities and expertise are critical parts of the solution, not just a reflection of the problem. And 2, that the insurers and supervisors were all pursuing the same goal, the retention of sustainable private insurance markets that serve the needs of all customers. As with any insurance conversation, though, it's always good to start with the risks. In this case, as most of you already know, the principal risks stem from the unprecedented spike in CO2 concentrations in the atmosphere that is warming our oceans, elevating sea levels, intensifying wildfires, increasing the severity of hurricanes and convective storms, and raising surface temperatures in ways humans have never experienced. Those natural science indicators are in turn contributing to a growing protection gap and massive transfers of risk from private to public balance sheets. In fact, if today's trend lines extend for another 5 years, the California FAIR Plan and Florida citizens will be managing over $2 trillion of insured exposures. Again, that's $2 trillion. Not surprisingly, these shifting dynamics are putting pressure on the industry's traditional risk signaling and policyholder incentivizing roles due to a variety of reasons. First, using a 12-month policy to effectively signal long-term risk trends has its limitations, particularly when insurers are among the only financial sector actors sending those signals. Second, economic growth and development are still too often prioritized over climate adaptation and proper risk management. In fact, according to one UCLA study, 52%, so over half of new homes built between 2000 and 2017, were in the 4th and 5th quintile of the National Risk Index. What that means is we continue to build in places where we know there are climate risks that are going to threaten that property. Claims inflation continues to outpace CPI. Our long-term climate modeling still lacks the granularity needed to be actionable at a local level. And our insurance products are still designed to send risk behavior signals to individuals, yet the most meaningful risk mitigation strategies are increasingly at the community level. These factors are rendering traditional insurance tools of actuarial science, data management, risk modeling, and portfolio diversification insufficient in the mid to long term as it relates to the most acute climate exposures. That is why we must urgently shift our energy and focus to bending the climate risk curve, not trying to just price it. Yet when you look at the ecosystem in which holistic risk management is supposed to occur, you begin to understand the complexity, and particularly at a scale level, can cause confusion, if not paralysis. Take the protection gap. The NEIC's recently released National Climate Resilience Strategy rightfully focuses on both the increased insurance uptake and risk reduction as key steps to closing the gap between economic and insured losses. The trick, of course, is to understand the interplay between the two. the complexity grows when it comes to the various assets that a community is comprised of. According to the National Academy of Sciences, defining a holistic climate adaptation strategy at the community level is nearly impossible since it depends on which of the 6 asset types the community prioritizes. And finally, while all adaptation is local, the enabling actions happen across a complex web of government entities implementing a series of complex long-term projects, all of which are chasing the same dollars. Despite these formidable challenges, we're beginning to see the initial stages of meaningful action being taken by both the public and private sectors. At the homeowner level, the Insurance Institute for Business and Home Safety continues to undertake groundbreaking research to constantly expand and improve its life-saving fortified structure standards. States like Alabama, Louisiana, North and South Carolina are catalyzing homeowner retrofit programs that have proven their effectiveness and economic value several times over. And the private flood market grew 24% in 2022, reflecting capital availability, diversification benefits, and customer dissatisfaction with existing options. At the community level, philanthropies are beginning to stand up technical assistance networks to support Community Disaster Resilience Zone Act communities in securing the knowledge, capabilities, and funding to act. Those networks, in turn, are catalyzing pilots and fostering new thinking. 2 examples that I'm personally involved in include a project in North Carolina where Duke's Nicholas Institute is partnering with the state and a range of others to identify and support CEDAR's designated communities with enhanced data, analytics, and modeling. Another is a new insurance model called community-based catastrophe insurance that has the potential of dramatically narrowing the protection gap, achieving community-level scale for risk management purposes, and aligning different stakeholders around a common peril. None of us will forget COVID as that common peril and how it brought stakeholders together for a common cause. We need to do the same thing with climate. Innovation groups like Insure are establishing new networks to harness the passion, energy, of young insurance professionals to collectively tackle climate issues. Communities are investing in early warning and monitoring tools. And in what could be a game changer, the IBHS and others are expanding their focus to include community-level risk mitigation for perils such as wildfire that require more than home-by-home efforts. At the state level, many governors are elevating resilience and adaptation functions to the cabinet level. Building codes are reemerging as a topic of public debate. The NAIC Protection Gap Dashboard, when it is ultimately deployed, will be a tremendous asset for policymakers and local governments. And even non-insurance state agencies like New York's Energy Research and Development Authority are spending millions of dollars testing new insurance models for critical transitionary technologies. In Washington, D.C., the designation of these community disaster resilience zones have begun to prioritize federal resources, galvanize formal and informal support networks, and focus private sector action on the communities that need it most. Hopefully, the designation process will be coupled ultimately with a tax incentive for private sector investment in those same communities. In addition, insurers are promoting a range of Stafford Act reforms that should broaden the use of insurance tools to strengthen community and state resilience. And of course, the various pools of funding authorized by the Inflation Reduction Act, the Bipartisan Infrastructure Bill, and other spending measures have begun to trickle down to the most truly in-need communities. And finally, at that global or societal level, the COP negotiators have put climate adaptation at the same level of importance as climate mitigation, recognizing that for many, the physical threats of climate are not theoretical, they're already a reality. And in some industry circles have begun to consider which models might exist that could replicate the profound societal benefit that industry-sponsored organizations like Underwriters Laboratory or the Insurance Institute for Highway Safety have had on managing societal risks. And another encouraging sign, it's worth noting that the US is not the only place where the market is starting to innovate. In fact, Marsh McLennan has partnered with the UN high-level climate champions the past 2 years to issue reports at COP27 and COP28, tracking insurance industry efforts to catalyze adaptation through insurance mechanisms. Altogether, we've documented over 50 projects with a diverse array of partners utilizing a series of innovative approaches, including nature-based solutions, extended policy durations, blended finance mechanisms, anticipatory finance, and impact-oriented public-private partnerships. That's a lot of activity, but it's still not enough, which is why I'd like to conclude my observations with 5 recommendations on how the insurance sector and the insurance supervisors can work together to equip communities, meaning your constituents and our clients, with the tools and knowledge to face their futures with confidence. First, in this era of artificial intelligence, data lakes, and supercomputing, we should ensure that no community lacks the risk data and analytics to make risk-informed climate adaptation decisions. The industry, including supervisors, should actively embrace the various technical assistance programs being stood up as pathways to providing much of the needed analytical support to these in-need and at-risk communities. As referenced earlier, I'm part of a Duke University project looking to do precisely this with several North Carolina communities this year, and we look forward to collaborating with Commissioner Causey and his team to optimize the impact. In addition, we should all reciprocate NOAA's efforts to improve the quality, delivery, and relevance of their world-leading data and analytics, whether that's through the National Science Foundation's new collaborative research centers or through other programs. Second, we must develop a science-based approach to documenting the risk reduction benefits of community-wide adaptation projects. Without this, adaptation funding will be sub-optimized, private capital will sit on the sidelines, and communities will have little practical guidance on what they can do to retain competitive insurance markets. In other words, defining the resilience dividend is climate's version of electrical appliance safety standards and will require the modeling equivalent of crash test dummies to test and retest community resilience options. Active steps we can take include improving the granularity and quality of longer-term risk modeling, capturing those benefits at scale by deploying community-based catastrophe insurance programs, and exploring the impact on various community rating models. Third, we should create incentives for insurers and other private firms to invest in adaptation projects. The insurance sector holds 1 out of every 4 municipal bonds issued in the US today. We should use that market influence to encourage resilient infrastructure. Similarly, we should promote fundamental changes in government spending philosophies to favor recovery over resilience. Fourth, we should apply our risk-based expertise to all policy and regulatory decisions that affect communities' risk profiles, including land use approvals, building code adoption, local and state adaptation planning, large-scale infrastructure, and the budgeting and appropriation processes. Being ignorant of longer-term climate risk can no longer be an excuse for putting more economic value in harm's way. And finally, insurers, reinsurers, brokers, risk managers, and supervisors should develop a clear framework for leveraging the claims process as a unique opportunity to enhance the resilience of our residential and commercial building stock. Marsh McLennan has committed to starting this dialogue with every English language customer claim we manage. If we're serious about improving resilience as quickly as possible, this approach needs to be institutionalized. If we systematically undertook each of these steps, I'm confident that the insurance sector and its regulatory system would make a meaningful impact on the climate risk curve, in the process creating confidence in communities' ability to thrive while saving innocent lives, protecting local economies, and enabling competitive insurance markets. I'd like to end my remarks with a quote from one of my insurance sector heroes, William Henry Merrill. "We are doing something for manufacturers and buyers and users and property owners everywhere. We are actually doing something for humanity." For those of you who don't know, Mr. Merrill is the engineer that attended the 1892 World's Fair and made the first risk engineering report on electricity use in wooden factories and homes. That report, in turn, led to the establishment of Underwriters Laboratory, which is safe for electricity. This is the scale of impact that the insurance sector is capable of, and the scale of ambition that collectively we should strive for. I hope all of us here remember that as we turn off our UL reviewed appliances later tonight. Thank you, and have a great conference.